With the economy facing high inflation, the Federal Reserve has begun to raise interest rates. Investors should prepare for a bumpy ride in the months ahead, and so it's crucial that investors stay disciplined. Building a portfolio that has at least some less risky assets can be useful in helping you ride out volatility in the market. So that's why in our today's video, we've compiled a list of the 10 safest investments to make. Without further ado, let's begin. High-yield savings account. While not technically an investment, savings accounts offer a modest return on your money. You'll find the highest yield options by searching online, and you can get a bit more yield if you're willing to check out the rates table and shop around. Why invest? A savings account is completely safe in the sense that you'll never lose money. Most accounts are government insured up to $250,000 per account type per bank, so you'll be compensated even if the financial institution fails. Series 1 Savings Bonds. A Series 1 savings bond is a low-risk bond that adjusts for inflation, helping protect your investment. When inflation rises, the bond interest rate is adjusted upward. But when the inflation falls, the bond's payment falls as well. You can buy the Series 1 bond from treasurydirect.gov, which is operated by the U.S. Department of Treasury. The 1 bond is a good choice for protection against inflation because you get a fixed rate and an inflation rate added to that every 6 months, says Michaela Braden, former senior advisor for the Department of the Treasury, referring to an inflation premium that's revised twice a year. Short-term certificates of deposit. Bank CDs are always loss-proof in an FDIC-backed account, unless you take the money out early. To find the best rates, you'll want to shop around online and compare what banks offer. With interest rates already on the rise in 2022, it may make sense to own short-term CDs and then reinvest as rates move up. You'll want to avoid being locked into below-market CDs for too long. An alternative to a short-term CD is a no-penalty CD, which lets you dodge the typical penalties for early withdrawal. So you can withdraw your money and then move it to a higher-paying CD without the usual costs. Money market funds. Money market funds are pools of CDs, short-term bonds, and other low-risk investments grouped together to diversify risk and are typically sold by brokerage firms and mutual fund companies. Unlike a CD, a money market fund is liquid, which means you typically can take out your funds at any time without being penalized. Money market funds usually are pretty safe, says Ben Wakick, founder and financial planner of Guided Financial Planning in Minneapolis. The banks tell you what rate you'll get, and its goal is that the value per share won't be less than $1, he says. Treasury bills, notes, bonds, and tips. The U.S. Treasury also issues Treasury bills, Treasury notes, Treasury bonds, and Treasury Inflation Protection Security. All of these are highly liquid securities that can be bought and sold either directly or through mutual funds. Risk. If you keep treasuries until they mature, you generally won't lose any money unless you buy a negative yielding bond. If you sell them sooner than maturity, you could lose some of your principal since the value will fluctuate as interest rates rise and fall. Rising interest rates make the value of existing bonds fall and vice versa. Corporate bonds. Companies also issue bonds, which can come in relatively low-risk varieties issued by large profitable companies down to very risky ones. The lowest of the low are known as high-yield bonds or junk bonds. There are high-yield corporate bonds that are low-rate, low-quality, says Cheryl Kruger, founder of Growing Fortunes Financial Partners in Schaumburg, Illinois. I consider those more risky because you have not just the interest rate risk, but the default risk as well. The market value of a bond can fluctuate as interest rates change. Bond values move up when rates fall, and bond values move down when rates rise. The company could fail to make good on its promise to make the interest and principal payments, potentially leaving you with nothing on the investment. To mitigate interest rate risk, investors can select bonds that mature in the next few years. Longer-term bonds are more sensitive to change in interest rates. To lower default risk, investors can select high-quality bonds from reputable large companies or buy funds that invest in a diversified portfolio of these bonds. Dividend-paying stocks. Stocks aren't as safe as cash, savings accounts, or government debt, but they're generally less risky than high flyers like options or futures. Dividend stocks are considered safer than high-growth stocks because they pay cash dividends, helping to limit their volatility by not eliminating it. So dividend stocks will fluctuate with the market, but may not fall as far when the market is depressed. Stocks that pay dividends are generally perceived as less risky than those that don't. I wouldn't say a dividend-paying stock is a low-risk investment because there were dividend-paying stocks that lost 20% or 30% in 2008, Wackick says. But in general, it's lower risk than a growth stock. That's because dividend-paying companies tend to be more stable and mature, and they offer the dividends as well as the possibility of stock price appreciation. Preferred stocks. Preferred stocks are more like lower-grade bonds than common stocks. Still, their value may fluctuate substantially if the market falls or if interest rates rise. Like a bond, preferred stocks make a regular cash payout. But unusually, companies that issue preferred stocks may be able to suspend the dividends in some circumstances, though often the company has to make up missed payments. And the company has to pay dividends to preferred stocks before dividends can be paid out to common stockholders. Preferred stocks is like a riskier version of a bond, but is generally safer than a stock. Money market accounts. A money market account may feel much like a savings account, and it offers many of the same benefits, including a debit card and interest payments. The money market account may require a higher minimum deposit than a savings account, however. Rates on money market accounts may be higher than comparable savings accounts. Plus, you'll have the flexibility to spend the cash if you need it, though the money market account may have a limit on your monthly withdrawals, similar to a savings account. You'll want to search for the best rates here to make sure you're maximizing your returns. Money market accounts are protected by the FDIC with guarantees up to $250,000 per depositor per bank. So money market accounts present no risk to your principal. Fixed annuities. An annuity is a contract, often made with an insurance company, that will pay a certain level of income over some time period in exchange for an upfront payment. The annuity can be structured many ways, such as to pay over a fixed period, such as 20 years, or until the death of the client. With a fixed annuity, the contract promises to pay a specific sum of money, usually monthly, over a period of time. You can contribute a lump sum and take your payout starting immediately, or pay into it over time and have the annuity begin paying out at some future date. So guys, let me know down in the comments section below, which one of them are you going to try for yourself? For more interesting content, give this video a thumbs up and don't forget to subscribe to the channel for more awesome content. Have a nice day, and I will see you in the next video.